Something fundamental has shifted in the global financial system, and it didn't happen during a crisis weekend or a market crash. It happened quietly, in the background of the system most people assume is stable. The kind of shift that doesn't trigger alarms, but eventually changes what savings, pensions, and entire markets are built on. In late 2025, a financial threshold was crossed that had not been touched since the last time the global system nearly failed. No emergency meeting. No breaking news banner. Just a number rolling over, and continuing in one direction without ever bouncing back. Over a little more than a decade, the second largest economy in the world reduced its exposure to American government debt by more than $600 billion. Not all at once. Not during panic. Month by month, year by year, the line kept moving lower. Imagine a chart pinned to a wall. Each year, one small step down. No rebounds. No hesitation. Just a steady retreat. This was not reactive behavior. It was not emotional. It was not driven by headlines or political noise. It was deliberate execution, carried out slowly enough to avoid attention, but consistently enough to matter. At its peak, this relationship formed one of the central pillars of modern finance. One country absorbed global demand and issued debt. Another recycled its trade surplus back into that debt. Dollars flowed outward. Treasury bonds flowed back. Stability depended on that loop continuing. That loop is now being dismantled. The total reduction is large, but the pattern is more important than the sum. The decline never paused. It never reversed. Even during periods when holding that debt would have been profitable, the position kept shrinking. That tells you this wasn't about yield or timing. It was about exposure. Most observers dismiss this as routine diversification or diplomatic signaling. But those explanations fail when you widen the lens. Because while this position was being reduced, something else was happening in parallel, something that doesn't appear in treasury tables at all. A substitution was underway. Capital rarely disappears. It moves. And when you track where it goes instead of focusing only on what was sold, the intent becomes clear. This shift didn't announce itself because it didn't need to. The system continued to function. Markets stayed liquid. Payments cleared. On the surface, nothing broke. That's exactly why it worked. But stability can exist right up until the moment it doesn't, especially when it's supported by assumptions that no longer hold. And the assumption being quietly abandoned here is one the entire dollar-based system depends on. To understand why this matters, and why the surface still looks calm, you need to understand who is still buying, who is quietly stepping away, and why those two groups are not the same. That's where the story actually begins. On the surface, the system still looks healthy. In fact, it looks stronger than ever. Foreign ownership of American government debt has reached record levels, and demand appears broad, deep, and stable. To a casual observer, that should be reassuring. It isn't. In markets like this, records are not always signs of confidence. Sometimes they're signs of strain. When participation reaches extremes, it often means buyers are acting for reasons other than belief in long-term value. The system keeps functioning, but the reasons it functions begin to change. That distinction matters more than the headline numbers. Debt markets don't fail because buyers vanish overnight. They fail when the quality of demand shifts quietly beneath the surface. When the participants who want to hold an asset are gradually replaced by participants who have to hold it, prices can remain stable right up until they don't. Not all buyers are the same. Some buyers purchase government debt because they see it as a safe, long-term store of value. They choose the asset. They can walk away if conditions change. Others hold it because their economic structure leaves them little alternative. They don't choose the asset, they inherit it. The difference is subtle but critical. Think of it this way: one buyer walks into a store because they want the product. Another is handed the product as part of their job and told to keep it on the shelf. Both count as ownership, but only one represents conviction. Over the past several years, an increasing share of Treasury demand has come from the second category. Export-driven economies accumulate dollars through trade whether they want to or not. Those dollars must be parked somewhere, and U.S. government debt remains the easiest place to put them without disrupting currency relationships. This is not optimism. It's obligation. Other holders appear in the data even though they aren't true decision-makers at all. Custodial centers hold assets on behalf of clients whose identities never show up in official statistics. These holdings inflate totals and create the appearance of broad participation, even though the underlying conviction belongs elsewhere, and can leave without warning. This is why aggregate numbers can be misleading. Totals look strong. Ownership appears diversified. But the system is increasingly supported by participants who are constrained, indirect, or structurally locked in. That's not resilience. That's fragility with good optics. When markets rely on forced participation, they behave normally only as long as the forces remain intact. Trade patterns, currency regimes, political constraints, these are not permanent features. They shift. And when they do, forced buyers don't gradually reduce exposure. They exit all at once. This is what makes the current environment dangerous. Demand doesn't fade smoothly. It snaps. Liquidity that looked abundant evaporates. Yields don't rise gently, they gap higher. What had seemed like deep stability is revealed as shallow dependence. And this is exactly the kind of environment where quiet, strategic exits make sense. You don't wait for the illusion to break publicly. You step away while the surface still looks calm. Which raises the next question. If the system still appears stable, and if total demand still looks strong, what signal convinced certain participants that stability itself was no longer trustworthy? The answer isn't found in the debt market at all. It's found in what was being accumulated at the same time. Every large financial move leaves evidence. Capital doesn't vanish. It relocates. And when a withdrawal happens quietly over many years, the only way to understand it is to follow where the money went next. That trail doesn't lead back into markets. It doesn't lead into new forms of yield. It leads somewhere far less fashionable, and far more revealing. As exposure to U.S. government debt declined, another balance sheet moved steadily in the opposite direction. Not sporadically. Not in response to headlines. But with a discipline that mirrors the exit itself. Month after month, the position grew. Picture two lines on a chart. One drifting lower without interruption. The other climbing at nearly the same pace. No volatility. No hesitation. Just a quiet exchange taking place in the background while markets focused elsewhere. This wasn't a search for returns. The asset being accumulated doesn't generate income. It doesn't benefit from economic growth. It doesn't rely on financial engineering or counterparty promises. It simply exists, finite, inert, and outside the system it's being traded against. That choice matters. When institutions exchange debt claims for something that produces no yield, they're not optimizing. They're insulating. They're accepting opportunity cost in exchange for certainty. And that trade only makes sense when the risk you're avoiding is larger than the return you're giving up. This is not a reaction to short-term volatility. The accumulation didn't begin during a crash. It continued through periods of market strength. It accelerated even when holding traditional assets would have been profitable. That tells you the concern isn't about markets next quarter. It's about systems over decades. Gold does not hedge recessions. It hedges distortion. It becomes attractive when trust in abstraction weakens, when numbers on screens grow faster than the real economy beneath them. This is why the timing is so revealing. The accumulation coincided with rising debt levels, expanding deficits, and a shift in how monetary authorities talk about limits. Not secret changes. Public ones. Statements, policies, frameworks that treat balance sheet expansion as a tool rather than a risk. Nothing here requires inside knowledge. The data is available. The arithmetic is simple. What's rare is acting on it early, while the system still looks functional. And this behavior isn't isolated. Across multiple regions, official reserves began tilting toward tangible assets during the same period. Not in coordination, but in response to the same pressure points. When different actors reach the same conclusion independently, it's usually because the constraint they're responding to is real. This substitution doesn't announce itself because it doesn't need to. It doesn't disrupt markets. It doesn't force repricing, not yet. It simply removes a layer of confidence that had been taken for granted. Debt relies on belief in future purchasing power. Hard assets do not. Choosing one over the other is a decision about which risk is survivable. And once that decision is made at scale, it rarely reverses. Because substitution isn't about timing the exit. It's about making sure you're not still inside when the system finally has to reconcile numbers with reality. What makes this moment unusual isn't the accumulation itself. That has happened before. What makes it different is what it's being accumulated against, and how long that imbalance has been allowed to grow. To understand where this leads, you need to look past assets entirely and toward the constraint that forced this choice in the first place. That constraint isn't political. It isn't cultural. And it isn't optional. Every financial system eventually encounters a limit. Not a political one. Not a regulatory one. A structural limit, the kind that cannot be negotiated, postponed, or voted away. For a long time, the modern system appeared immune to this. Debt expanded. Balance sheets grew. Markets absorbed issuance without visible strain. Whenever pressure appeared, new tools emerged to relieve it. Rates were lowered. Liquidity was added. Confidence was restored. The illusion of flexibility became a belief in permanence. But flexibility is not the same as freedom. Systems can bend only as long as the underlying constraints remain intact. When those constraints are ignored for too long, adjustment doesn't happen gradually. It happens abruptly. The constraint being tested now is not hidden. It's been visible for years, printed openly in budget documents and debt schedules. What changed wasn't the number itself, but the pace at which it began to grow, and the assumptions required to support that growth. At a certain scale, debt stops functioning as a tool and starts behaving like a force. Servicing costs compound. Refinancing becomes continuous. The system no longer borrows to invest or smooth cycles. It borrows to remain operational. That's the line that matters. When new issuance is required not to fund growth, but to pay interest on existing obligations, the system enters a different phase. One where stability depends entirely on uninterrupted demand and cooperative conditions. This phase doesn't announce itself with crisis. It hides inside routine operations. Auctions clear. Payments are made. Markets stay open. On the surface, everything still works. But the margin for error disappears. At this stage, small changes produce outsized effects. A modest rise in yields multiplies into massive increases in servicing costs. A slight reduction in demand forces higher rates, which increase deficits, which require more issuance, feeding back into the same pressure point. The system becomes reflexive. This is where assumptions matter more than policies. The entire structure assumes that buyers will always be there, that refinancing will always be possible, and that confidence will persist long enough to roll obligations forward indefinitely. That assumption held for decades because the system grew alongside the real economy. But when obligations begin to grow faster than the capacity supporting them, confidence stops being rational and becomes habitual. Habit can persist longer than logic, but not forever. This is why certain actors began reducing exposure long before markets showed stress. They weren't responding to panic. They were responding to math. They saw a structure that required constant expansion to remain stable. A structure where even a pause, not a reversal, would introduce instability. And they understood that systems built on uninterrupted momentum eventually fail at the point where momentum slows, not when it stops. The constraint doesn't care about intent. It doesn't respond to credibility. It doesn't negotiate. It expresses itself through mechanics. And once it starts asserting itself, the range of available responses narrows very quickly. This is the environment in which substitutions begin to make sense. This is where holding claims on future purchasing power becomes riskier than holding something that doesn't rely on the future behaving as planned. The system can still function in this phase. Sometimes for years. But it does so by becoming increasingly sensitive, increasingly dependent, and increasingly asymmetric. Upside becomes limited. Downside becomes sudden. And this is where the next shift occurs, not in assets, but in policy behavior itself. Because when constraints tighten, institutions don't stop acting. They change how they act. That change is subtle at first. Almost technical. Often misunderstood as routine. But it marks the point where the system stops adapting, and starts compensating. Once a system reaches its constraint, the goal of policy quietly changes. It no longer aims to fix underlying imbalances. It aims to keep the system operating despite them. This transition is subtle. It doesn't arrive with new laws or dramatic announcements. It shows up in tone. In phrasing. In how officials describe the purpose of their actions. What used to be framed as temporary becomes normalized. What used to be extraordinary becomes routine. The language shifts first. Stability replaces growth as the stated objective. Liquidity replaces discipline. Risk management replaces reform. None of these words sound alarming on their own. In fact, they sound responsible. But taken together, they signal something important. The system is no longer trying to reduce pressure. It's trying to redistribute it. At this stage, policy becomes less about outcomes and more about continuity. The priority is avoiding disruption, even if that means accumulating long-term distortions beneath the surface. Markets are kept functioning. Rates are guided. Volatility is smoothed. But the underlying arithmetic remains untouched. This is where compensation begins. Instead of confronting the constraint directly, institutions adjust the environment around it. Time horizons are extended. Assumptions are softened. Models are recalibrated. The system is encouraged to accept conditions that would once have been considered abnormal. None of this requires deception. It works because it feels incremental. Each adjustment is defensible in isolation. Each step appears modest. The problem only becomes visible when you connect them. Consider how responses change when pressure builds. Instead of allowing rates to reflect risk fully, mechanisms emerge to dampen that signal. Instead of letting demand fluctuate naturally, tools are deployed to ensure participation remains sufficient. Instead of reducing issuance, structures are created to absorb it. These actions don't remove risk. They relocate it. Risk moves from markets to balance sheets. From private actors to public institutions. From visible prices to invisible commitments. The system stays calm, but the cost of calmness accumulates elsewhere. This is why earlier substitutions mattered. Actors paying attention understood that once policy enters this phase, the nature of risk changes. It becomes less volatile, but more systemic. Less visible, but more pervasive. In this environment, traditional indicators lose meaning. Low volatility no longer signals health. High participation no longer signals confidence. Stability becomes an output of intervention, not a reflection of balance. And that distinction matters, because intervention has limits. Compensation works as long as credibility holds and tools remain effective. But each use reduces future flexibility. Each adjustment narrows the range of remaining responses. Eventually, the system becomes dependent on actions that were once considered temporary. This is not failure. It's adaptation under constraint. But adaptation has consequences. Because when a system compensates instead of correcting, pressure doesn't disappear. It accumulates. And accumulated pressure doesn't release gradually. It releases when the compensating mechanisms can no longer keep up. This is why watching policy behavior matters more than listening to policy statements. The shift isn't in what is promised. It's in what is required to keep things from breaking. And once a system reaches the point where continuity itself demands constant intervention, it has entered a phase that history recognizes very clearly, even if the names and tools look different each time. What comes next isn't about intent or ideology. It's about mechanics. And those mechanics follow patterns that repeat, regardless of who is in charge. At first, the compensating mechanisms appear to work. Markets remain liquid. Auctions are covered. Volatility stays contained. From a distance, the system looks calm, even resilient. But that calm is no longer organic. It's engineered. And engineered stability leaves fingerprints. One of the earliest signs appears not in prices, but in behavior. Risk-sensitive participants begin to shorten their time horizons. Instead of committing capital for long durations, they prefer flexibility. Liquidity becomes more valuable than yield. Optionality becomes more important than return. This shift doesn't show up in headlines. It shows up in maturity profiles, positioning data, and the quiet migration toward instruments that can be exited quickly. When long-term confidence weakens, even slightly, the system doesn't freeze. It becomes shallow. That shallowness is the real danger. In a deep market, shocks are absorbed. In a shallow one, they propagate. Small disturbances travel farther and faster because there's less genuine conviction anchoring prices. The system still moves smoothly, until it doesn't. At the same time, the burden on stabilizing institutions increases. They are asked to do more often, and with fewer alternatives. Each intervention becomes slightly larger than the last. Each temporary measure lingers longer. The line between routine operations and extraordinary support begins to blur. This is where side effects accumulate. Signals that would normally warn participants of imbalance are muted. Pricing mechanisms lose some of their informational value. Feedback loops weaken. The system appears less volatile, but also less responsive. Pressure doesn't dissipate. It migrates. And migration creates concentration. Risk that was once distributed across markets begins to pool inside institutions that are assumed to be immovable. Balance sheets expand. Commitments grow. The system becomes increasingly dependent on the credibility of a few central nodes. That dependency works, until it becomes visible. Once participants begin to realize that stability depends on constant support rather than underlying balance, their behavior changes again. Not abruptly. Not dramatically. But persistently. Exposure is trimmed. Alternatives are explored. Hedging becomes more structural than tactical. This is not panic. It's adaptation. The irony is that the system interprets this adaptation as confirmation that its policies are effective. Markets remain orderly. Participation continues. Yields behave. The feedback appears positive. But beneath that surface, sensitivity is rising. In highly compensated systems, reactions become nonlinear. The longer pressure is suppressed, the more energy is stored. When adjustment finally occurs, it doesn't unwind in the reverse order it was built. It breaks at the weakest point. That point is rarely where people expect. This is why watching price levels alone misses the story. The real signal is in the growing reliance on intervention to preserve normal function. When continuity itself becomes a policy objective, fragility is already present, even if nothing has failed yet. And this brings us to the most misunderstood part of the process. Because once compensation becomes systemic, the next step isn't collapse. It's transformation. A change in how the system defines money, risk, and obligation, not by choice, but by necessity. That's the transition now taking shape. Every financial system rests on an assumption so basic it's rarely questioned, that money is a neutral tool. A medium of exchange. A unit of account. Something that reflects value rather than reshapes it. That assumption only holds as long as money remains constrained. When compensation becomes systemic, neutrality fades. Money stops acting as a passive measure and starts behaving like an active force. Not because anyone intends it to, but because the system begins using it to absorb pressure that can no longer be handled elsewhere. This shift is subtle at first. It appears in how liquidity is described. In how balance sheet expansion is framed as maintenance rather than stimulus. In how new money enters the system not to finance growth, but to preserve continuity. The distinction is easy to miss, because the mechanics look familiar even as the purpose changes. In earlier phases, monetary tools were used episodically. They addressed shocks, stabilized markets, and then receded. Now they linger. They operate in the background. They become part of the baseline rather than the exception. That permanence matters. When money creation moves from response to routine, its effects change. It no longer acts like a bridge over a temporary gap. It becomes part of the structure itself. And structures shape behavior. Participants adapt quickly. If liquidity is always available, risk-taking increases. If losses are absorbed, discipline erodes. If prices are stabilized, signals weaken. None of this requires recklessness. It emerges naturally from incentives. The system becomes easier to operate, and harder to exit. This is where the meaning of value begins to shift. Assets are no longer judged primarily by what they produce, but by how they respond to liquidity conditions. Cash flows matter less than correlation. Scarcity matters less than accessibility. Money stops measuring reality and starts distorting it. Importantly, this doesn't feel dangerous at first. It feels efficient. Markets run smoothly. Shocks are muted. The system appears more controllable than ever. That sense of control reinforces confidence in the tools being used. But control has a cost. When money absorbs pressure, it carries it forward. It embeds distortion into prices, expectations, and balance sheets. Over time, the gap between nominal values and real capacity widens. The system becomes increasingly dependent on the continued availability of liquidity to validate the numbers it produces. This dependency is the turning point. Because once money is required to sustain valuations rather than facilitate exchange, withdrawing it becomes destabilizing. The system loses its ability to normalize. Any attempt to restore constraint threatens the very stability those tools were meant to preserve. This is why certain actors began repositioning long before this phase became obvious. They weren't predicting collapse. They were recognizing that once money loses neutrality, the rules governing value change permanently. And when rules change, assets that rely on abstraction become riskier than assets that rely on physical limits. The transformation doesn't announce itself with failure. It announces itself with a quiet shift in what money is used for. And once that shift is complete, the final stage is no longer optional. It's mechanical. For a long time, the system benefits from separation. Financial values float upward while the physical economy moves more slowly beneath them. Assets are repriced. Balance sheets expand. Markets adapt. As long as money remains abstract, this separation feels manageable. But abstraction only works until it runs into something that cannot be abstracted. Real economies are built on constraints that do not respond to liquidity. Energy must be produced. Goods must be manufactured. Labor must be paid. Infrastructure must be maintained. These realities do not scale at the speed of balance sheets, and they do not adjust simply because money is more available. This is where the tension begins to surface. As monetary conditions remain loose and compensating mechanisms stay active, demand expressed in financial terms continues to rise. But supply, anchored in physical systems, responds more slowly. The gap between nominal demand and real capacity widens. Prices don't rise because of speculation alone. They rise because more claims are chasing the same underlying output. At first, this looks temporary. Bottlenecks are blamed. Shocks are cited. Transitions are invoked. But when the gap persists, explanations start to stretch. What was once described as cyclical becomes structural. What was once considered transitory becomes accepted as normal. This is not inflation in the textbook sense. It's distortion expressing itself through prices. The system responds the only way it knows how, by trying to manage expectations. If people believe price increases are temporary, behavior stays contained. If confidence holds, pressure is delayed. The narrative becomes as important as the mechanism. But narratives have limits. When price changes persist long enough to alter behavior, the system loses another layer of flexibility. Consumers adjust. Producers adapt. Contracts are rewritten. Once that happens, returning to the previous state becomes impossible without disruption. This is where monetary neutrality breaks down completely. Money no longer just distorts asset prices. It reshapes economic behavior itself. People respond not to value, but to protection. Not to productivity, but to preservation. At this stage, attempts to restore constraint become dangerous. Tightening monetary conditions doesn't simply slow demand. It threatens the structures that have grown dependent on constant support. The system faces a choice that isn't really a choice. Either allow prices and valuations to adjust sharply, or continue compensating and accept further distortion. This dilemma doesn't resolve cleanly. It drags on. Pressure builds unevenly. Some sectors absorb more stress than others. Inequality widens. Trust erodes quietly. And this is where the global dimension becomes impossible to ignore. Because money doesn't exist in isolation. It exists in relation to other currencies, other systems, and other choices. When one system continues to abstract while others begin to constrain, imbalances don't stay contained. They spill outward. This is the point where external actors stop adapting and start repositioning. Not out of ideology, not out of rivalry, but out of necessity. Because once abstraction collides with reality, the cost of holding claims denominated in that abstraction begins to rise. And that cost doesn't show up all at once. It accumulates. For most of the modern era, the system benefited from an extraordinary privilege: it could export imbalance. Excess liquidity flowed outward. Debt was absorbed abroad. Pressure that would have destabilized a closed system was dispersed globally. That arrangement worked because the rest of the world accepted it. Not enthusiastically. Not blindly. But pragmatically. Holding dollar-denominated claims made sense as long as those claims preserved purchasing power and provided stability relative to alternatives. Participation was rational, even if imperfect. That condition is now changing. As abstraction collides with reality at home, its effects become visible abroad. Foreign holders experience the consequences not as theory, but as erosion. Claims that once felt safe begin to behave differently. Returns flatten. Volatility increases. Currency risk re-enters calculations that had been dormant for decades. This is where cooperation quietly weakens. External actors don't need to coordinate or confront. They simply adjust preferences. Exposure is trimmed. Maturities are shortened. Reserves are diversified. These moves don't disrupt markets immediately. They reduce tolerance. Tolerance is the hidden stabilizer. When tolerance is high, imbalances persist. When tolerance falls, the system becomes sensitive. Small changes in flow produce large effects. What once passed unnoticed begins to register. This is why shifts in foreign behavior matter more than headlines. It's not about who is buying this month or selling next quarter. It's about how much deviation the system can absorb before reactions compound. As external demand becomes more conditional, the burden of absorption shifts inward. More issuance must be held domestically. More risk must be intermediated locally. More adjustment must occur inside the system rather than being distributed globally. That shift is subtle, until it isn't. Domestic institutions step in to fill gaps. Balance sheets expand further. Interventions become larger and more frequent. What was once shared pressure becomes concentrated pressure. And concentration changes dynamics. At this point, feedback loops tighten. External caution leads to internal compensation. Internal compensation reinforces external caution. The system begins responding to its own responses. This is not a collapse dynamic. It's an acceleration dynamic. The system still functions. Payments clear. Markets trade. But the margin for error continues to shrink. Each new layer of support raises the stakes of the next decision. Each attempt to preserve stability increases dependence on the very mechanisms creating imbalance. This is where time becomes critical. Adjustments that could have unfolded slowly now compress. Decisions that once had years to play out are forced into months. The system doesn't break because it runs out of tools. It breaks because it runs out of room. And once room disappears, choices become binary. That is the stage the system is approaching now, where external cooperation is no longer assumed, and internal compensation is no longer sufficient on its own. What follows is not a sudden event. It's a sequence. A progression driven not by politics or preference, but by constraint. And that sequence leads directly to the final mechanism, the one that resolves imbalance not by fixing it, but by redefining it. That comes next. When tolerance fades, room disappears, and compensation reaches its limits, the system doesn't improvise. It follows a sequence. Not because anyone designed it that way, but because constraints leave only a narrow set of viable paths. The first stage is quiet normalization. Actions that once required justification become routine. Interventions are no longer described as responses to stress, but as maintenance. The language shifts again, this time toward permanence. Tools are no longer temporary bridges. They become part of the architecture. Markets adapt quickly. Participants stop questioning whether support will arrive and begin pricing around the assumption that it must. This is not optimism. It's dependency. Volatility stays contained, but sensitivity increases. The system becomes less forgiving, not more stable. The second stage is absorption. As external participation weakens, internal actors are required to take on more of the load. Balance sheets expand further. Risk pools concentrate. Institutions that were once intermediaries become warehouses for exposure. This keeps markets functioning, but it changes who ultimately carries the burden. At this point, price signals become increasingly unreliable. Yields no longer reflect risk. Asset values no longer reflect scarcity. Stability is preserved, but at the cost of information. The system can still move forward, but it loses its ability to self-correct. The third stage is constraint recognition. This is where policy faces its narrowest corridor. Tightening becomes dangerous because it threatens structures that now depend on accommodation. Loosening becomes dangerous because it accelerates distortion. The system oscillates between these pressures, attempting to balance them without resolving either. This is not indecision. It's limitation. Every move is reactive. Every adjustment buys time, but less time than the last one. The horizon compresses. What once unfolded over cycles now unfolds within a single cycle. The fourth stage is redefinition. When correction becomes impossible without collapse, systems redefine the unit being corrected. Obligations are honored in form, but altered in substance. Claims are preserved nominally, but transformed in real terms. The system avoids default not by paying less, but by paying differently. This is the most misunderstood part of the process, because it doesn't look like failure. Contracts are honored. Markets remain open. Institutions continue operating. The adjustment happens beneath the surface, inside the medium through which value is measured. And because it happens gradually, it's often mistaken for normal change. The final stage is acceptance. Not acceptance by decree, but by behavior. People adapt to new baselines. Expectations reset. What once felt temporary becomes permanent. The system stabilizes again, but around a different center. History doesn't record this as collapse. It records it as transition. What determines who absorbs the cost is not intent or fairness, but position. Those holding claims tied to abstraction experience erosion. Those holding assets tied to constraint experience continuity. This is the sequence that emerges when room runs out. It does not require coordination. It does not require crisis. It only requires time, scale, and arithmetic. And at this point, the system is no longer deciding whether to follow it. Only how quickly. All that remains is to name what has been happening all along, and to understand why it feels invisible until it's irreversible. That is where this leads. At this stage, the system is no longer drifting. It is executing. Not because a decision was made in a single moment, but because every alternative has quietly closed. The mechanism at work is not collapse. It is not default. It is not failure in the way most people imagine it. It is redefinition, the transformation of obligations without violating their formal terms. Throughout history, when systems reach this point, they resolve imbalance by altering the medium through which value is expressed. The debts are honored. The contracts are fulfilled. But the unit that measures fulfillment changes in meaning. This is the distinction that matters. When a system cannot reduce obligations and cannot allow open default, it turns to the only remaining variable it controls, the purchasing power of its currency. Not abruptly. Not visibly. But persistently. Money becomes the adjustment mechanism. This is why earlier shifts in behavior mattered so much. Why substitution away from long-duration claims began before stress was obvious. Why accumulation moved toward assets that do not rely on promises or policy. Those moves were not reactions to crisis. They were anticipations of transformation. What remains is not panic or collapse, but a new baseline, one where numbers still work, markets still function, and institutions still operate, but the meaning of value has changed. That is the cost of maintaining continuity when limits are reached. And it is already being paid. Currency debasement is often misunderstood as excess creation alone. In reality, it is a process of gradual erosion driven by necessity. The system does not aim to destroy purchasing power. It aims to preserve solvency while allowing obligations to be met. That distinction explains everything. As liquidity becomes permanent, as balance sheets expand to absorb risk, and as external tolerance fades, currency absorbs the imbalance that can no longer be carried elsewhere. Nominal values remain intact. Real values adjust. This is how systems survive when arithmetic turns against them. Historically, this process unfolds quietly. It does not require announcements. It does not require legislation. It occurs through routine operations, refinancing, rollovers, market support, reserve management. The adjustment is continuous, not episodic. Those holding fixed claims experience loss without default. Those holding flexible or scarce assets experience continuity without windfall. The system resets not through rupture, but through recalibration. This is why the final stage feels anticlimactic. There is no single moment where the old system ends and the new one begins. The transition is recognized only in hindsight, once the cumulative effect becomes undeniable. And by then, positioning no longer matters. Adaptation has already occurred. This is the mechanism that explains everything that came before. The quiet exits. The substitutions. The policy shifts. The global repositioning. The change in how money is used. None of it required coordination. None of it required foresight beyond arithmetic. None of it required secrecy. It only required scale. And once scale crossed a certain threshold, the outcome became mechanical rather than political. The system does not ask permission to adjust. It adjusts because it must. From a distance, this moment won't look dramatic. There will be no single headline marking the transition. No ceremony announcing the end of one system and the beginning of another. History rarely records these shifts as events. It records them as eras. That's because the adjustment we've been tracing doesn't happen through shock. It happens through accumulation. Every system that relies on abstraction eventually collides with something it cannot abstract away. In the past, it was gold convertibility. Before that, it was land, labor, or energy. Today, it is scale itself, obligations that grow faster than the capacity meant to support them. What makes this moment distinct is not the mechanism. That has appeared many times before. What's different is the size of the system and the number of people who depend on it behaving as if limits don't apply. Money, when unconstrained, creates the illusion that time can be borrowed indefinitely. That growth can be pulled forward without consequence. That obligations can be rolled forever as long as confidence holds. But confidence is not a resource. It's a byproduct. And it fades when reality stops matching representation. The system we live in today still functions. Markets open. Payments clear. Assets trade. But it now does so by continuously adjusting the meaning of value rather than confronting imbalance directly. That choice avoids collapse. It preserves form. But it does not preserve substance. And substance always matters eventually. This is why the most important changes happen quietly, years before they became obvious. Positions were reduced slowly. Substitutions were made patiently. Behavior adapted long before narratives caught up. Not because of panic, but because of understanding. Those actions weren't about predicting an endpoint. They were about recognizing a phase change. Once a system begins redefining its unit of account to preserve continuity, the outcome is no longer about success or failure. It becomes about distribution. Who absorbs the adjustment? Who carries the erosion? Who remains tied to abstraction and who is anchored to constraint? History shows that these transitions don't end systems. They transform them. The old rules don't vanish. They stop applying evenly. Numbers continue to rise. Markets continue to function. But the relationship between effort, value, and preservation changes. That's the real shift underway. Not collapse. Not crisis. But recalibration under pressure. It's uncomfortable because it's subtle. It doesn't announce itself loudly enough to demand attention. It simply persists long enough to become undeniable. By the time the change is obvious to everyone, it has already shaped outcomes. This is why the most important signal was never a single sale, a single policy, or a single announcement. It was the direction taken over time. The consistency. The lack of reversal. The willingness to accept lower returns in exchange for certainty. That direction wasn't about opinion. It was about arithmetic. And arithmetic doesn't negotiate. It doesn't care about policy preferences, political cycles, or narratives of exceptionalism. It asserts itself slowly, then all at once, not through collapse, but through consequence. The system will continue. It always does. But it will not continue unchanged. And the difference between those two outcomes is where the cost of this era will ultimately be paid. Quietly. Gradually. And inevitably.